Hello and welcome to another chapter on US taxation. So in the last chapter, we discussed about the above the line deduction, what are the above the line deduction and how these needs to be adjusted to arrive at the adjusted gross income. So in previous chapter, we learned that above the line deduction are also known as the adjustment to income and understood how they help to reduce the taxpayer adjusted gross income. Now, in this chapter, we are going to talk about the standard deduction, which is a fixed amount based upon the filing status. And then we also have the concept of itemized deduction, which are based on the actual eligible expense incurred during the year. So this decision is extremely important because it directly affects the final taxable income and the overall tax liability. So in this chapter, we will explore what is the standard deduction and how it works, what itemized deductions are and type of the expenses that qualify, and then how to decide which method it has to be adopted and what is the tax benefit that is going to come. Understanding this choice is essential because effective tax planning and maximized tax saving will happen if we have the best choice out of the. So with this, let's begin the chapter and look at the agenda. Okay, so the key agenda that you're going to cover today is introduction to the deductions after AGI. So we have discussed about the above the line deduction. Now we are going to deduct the introduction to deduction after AGI. So which are the two deductions, which is standard deduction and itemized deduction. So we're going to look at the concept of standard deduction and the itemized deduction. We'll also have a look at the medical expense deduction rule, state and local tax deduction, mortgage interest deduction, charitable contribution deduction. So these are the part of the itemized deduction. We're going to have the detailed understanding on each of these type of the deduction. And then we'll also have an understanding and looking at the concept that which is the best, whether it is the standard deduction or the itemized deduction. Then we'll understand how we have to report the deduction, which finally flows into Form 1040. We'll understand this entire concept with the detailed example, and then we'll have a key takeaways slide. So with this, we'll start the discussion, and let's move to the first slide then. Okay, so we are going to have a discussion on the introduction to deduction after AGI. So we already understood the concept of above the line deduction, and we understood that above the line deductions are there to derive the adjusted gross income, and then adjusted gross income are further subject to a certain set of deduction to derive the taxable income. So these deductions are applied below the line, and these deductions are done to derive the final taxable income. uh, Deductions after AGI includes two set of deduction, which is the standard deduction and the itemized deduction. These are reported in Form 1040, and for itemized deduction, they have to further provide the report in the form of Schedule A. So what are deduction after AGI? So deduction after AGI are the amounts that the taxable can subtract from the adjusted gross income to determine the taxable income. So adjusted gross income minus deduction, which is standard or itemized, give the taxable income. So this is the income on which the tax bracket will be applied to calculate the final tax. So these deductions help reduce the amount of the income and is subject to the taxation. So type of deductions are standard deduction. So what is standard deduction? A fixed deduction amount based on the filing status, which means that it is very easy to claim because there is no explanation required, no documentation required, no need to track the individual expense available to most taxpayer. And second is itemized deduction, a deduction based on the actual eligible expense incurred during the year, which includes medical expenses, dental expenses, state and local taxes, which we normally call as SALT, mortgage interest, and the charitable contribution. So these are the deductions which are part of the itemized deduction. And the taxpayer chooses their option only if the total itemized deduction exceeds the standard deduction. This is a logical tax planning concept as well. Wherever the amount of the itemized deduction is more than the standard deduction amount, which is eligible at a particular tax bracket and this is the filing status, then definitely uh, the individual will opt for the itemized deduction. So we'll move to the next slide. Okay, so we'll understand the importance of deductions of the AGI, which we discussed as the two set of deduction, which is standard deduction and itemized deduction. So these deductions are important because they reduce the taxable income, directly impact the final tax liability of an individual, and allow the taxpayer to optimize the tax savings. and it provides the flexibility in choosing the most beneficial option, whether it is standard deduction or itemized deduction. So when we look at the reporting flow, so we have a gross income. Gross income from the gross income, we have to do the adjustment to the above the line deduction to arrive at the AGI. So above the line deduction are reduced from the gross income to derive at the AGI, and then the from AGI we have to reduce the below the line deduction, which is standard deduction and the itemized deduction to arrive at the taxable income. This is the logical flow where we have to understand that how each of the deductions are actually help us to derive at the final taxable income. So we'll move to the next. Okay, so now we'll quickly understand the concept of the standard deduction in context to the US taxation. So standard deduction is a fixed amount that taxpayer can subtract from their adjusted gross income to determine the taxable income. So what does this mean? It simplifies the tax filing for the taxpayer because he does not have to produce any documentation. He can simply claim the standard deduction basis the filing status. It simplifies the taxpayer process because taxpayer can claim the predefined deduction without tracking the individual expenses. The standard deduction is claimed directly in the form 1040, so which means that there is no complication and no information needs to be provided in the Schedule A. And the taxpayer who choose this option cannot claim itemized deduction. So either of the option is available. You cannot claim both the deduction. The purpose of the standard deduction is to simplify the tax filing, provide a basic level of the tax relief to the taxpayer, reduce the need for detailing the record keeping, and then ensures the fairness by allowing a minimum deduction for the income. Standard deduction amount is dependent upon the filing status of the individual. Singles will have the fixed amount which is set annually, and then married filing jointly will have the higher combined amount. Head of the household will have the intermediate amount which falls between the single and the married joint family, depend upon the filing status as well. So additional standard deduction are given subject to certain conditions. So certain taxpayer may qualify for additional standard deduction, and this applies to taxpayer after the age of 65 years and taxpayers who are blind. So they are given the privilege of additional standard deduction if they are taxpayer are aged to 65 or more, and if the taxpayer is blind. These individual can claim an extra deduction amount, increasing the total standard deduction. Who can claim the standard deduction? Most taxpayers are eligible to claim the standard deduction. However, it may be limited or not available in certain situations, such as individual who claimed as a dependent on the another person's tax return, a married individual filing separately when the other spouse itemized deduction, and then certain non-resident taxpayers. So there are certain conditions, so it's not available to first, individual who are claimed as dependent on the another taxpayer. So if somebody is filing the return and individual is claimed as dependent on that particular person return, then this dependent cannot claim the standard deduction. Married individuals, if they are filing separately, when the other spouse itemized deduction, itemized other spouse is claiming the itemized deduction, then this spouse cannot claim the standard deduction, and certain non-resident taxpayer cannot also claim the standard deduction. So we move to the next slide. So what are the advantages of standard deduction? So when we look at the advantages here, the standard deduction provides the several benefit, and what those benefits are is simple and easy to apply. No need to maintain the detailed expense records, available to most taxpayer, and provide the guaranteed tax relief. And when one has to choose the standard deduction, so taxpayer chooses the standard deduction when their itemized deduction are less than the standard deduction. They prefer a simple tax filing process, and they do not have a significant deductible expenses. So they have to, compare both the standard deduction and the itemized deduction. And if they feel that the itemized deduction is less beneficial, they will continue claiming the standard deduction. First, definitely it has the benefit in terms of lesser documentation, plain, simple, and can easily be available, can easily be claimed through Form 1040 without filing the Schedule A. Standard deduction amount is the fixed deduction set by the IRS each year, which taxpayer can subtract from their adjusted gross income. The amount varies on the taxpayer filing status and the age and the certain eligibility condition that is adjusted annually with the inflation. Standard deduction depend upon the filing status. Single will have the base amount. Married filing jointly will have the higher combined amount. Married filing separately same as the single generally. House head of the household higher than the single but lower than the joint. Special rule for the dependent is there. If taxpayer is claimed as dependent on another person tax, standard deduction is limited. It is generally the greater of the minimum fixed amount or the earned income plus a small additional amount. This ensures that the dependent receives the reduced standard deduction. So we in the last slide we also looked at it that there is a certain exception that who cannot claim the deduction. So we understood that dependent cannot claim the standard deduction, and the exact standard deduction cannot be claimed by the dependent individual. And then there is special rule for the dependents. They can generally avail the standard deduction, which is the greater of the minimum fixed amount or the earned income plus a small additional amount. So this depend upon the multiple factors and also the rate which is being defined by the IRS. So standard deduction is typically easy to claim, and it requires minimal documentation and minimal kind of administrative hassles, and it can be claimed easily in the form 1040. So we'll move to the next slide. Okay, so now we'll talk about another set of deduction, which is the itemized deduction. So what are the itemized deduction? So itemized deductions are allowed taxpayer to deduct the actual eligible expenses incurred during the tax year, instead of claiming the amount of standard deduction. So this method is beneficial when the total deductible expenses exceed the standard deduction, resulting into the lower taxable income. Itemized deductions are reported on Schedule A and then transferred to Form 1040. So which means that there is an additional requirement to claim the to claim the itemized deduction, whereby they have to provide all the relevant information in form of Schedule A, which then flows into 1040 form. This is unlikely the standard deduction, whereby individual can directly claim the deduction in Form 1040 in the form of the standard deduction. So what is the itemized deduction? So itemized deduction consists of the specific category of the allowable personal expenses that IRS permits taxpayer to subtract from their adjusted gross income to arrive at the taxable income. So formalize that adjusted gross income minus itemized deduction is equal to the taxable income. Common type of itemized deductions are medical and dental expenses. Deductible only if expenses exceed a certain percentage of AGI. So it has a limit attached to it. We'll talk about that in the subsequent slide. Include costs such as the doctor visits, the prescription, and the medical expense, medical treatments. Then we have the state and the local taxes. So include the state income tax, property tax, and the local taxes, subject to the overall deduction limit. So we're also going to have a separate slide wherein we are going to have the detailed understanding of how we can claim the sole deduction. Then the mortgage interest paid on the loans used to purchase or improve a primary or the secondary residence, and must meet eligibility criteria. We also have a detailed slide on this. And then we have another deduction, which is the charitable contribution. So donation made to a qualified charitable organization, and we also include the cash or the property donation. And we also have a separate slide to talk about this. Then we have the casualty and the theft losses. So losses due to the disaster of the theft are subject to certain conditions and the limitations. So when should taxpayer itemize? So taxpayer should choose the itemized deduction when the total itemized deduction is greater than the standard deduction. They have significant deductible expenses such as the mortgage interest or the charitable contribution, and they want to maximize their tax savings. So typically, this benefit is more beneficial to set of individuals who are paying a huge amount of interest on their mortgage loan, and they have made some charitable contribution, or they have incurred some expenses on their medical treatment and the dental expenses. So if that is more than the standard deduction, then definitely there is a merit in terms of claiming those itemized deduction. Fill the proper form schedule A with all the documentary evidence, and then the information will flow into form 1040, and then they can claim this itemized deduction to reduce their final taxable income, which is subject to the tax. So we'll move to the next slide then. So what is the advantage of claiming itemized deduction? So itemized deduction can provide several benefits, reflects which potentially greater tax savings than the standard deduction, and reflect actual expenses incurred, and allow the taxpayer with the high deductible expenses to reduce the taxable income significantly. But what are the limitation here? So we have some limitation here. So detailed record keeping is required and documentation is required. Certain limits and thresholds are specific deduction, and then it is complexity compared to the standard deduction, because standard deduction is simple, plain, because that is a limit which is being fixed by the IRS. They simply have to understand their filing status and then claim the limit which is being set by the IRS. It's easy for SSC or individual to claim the standard deduction. So we'll move to the next slide then. Okay. Now we're going to talk about each of the itemized deduction in detail to understand that how we can claim the itemized deduction for respective heads. So first we're going to talk about medical expense deductible rule. So medical and the dental expenses are itemized deductions that taxpayer can claim if they incur qualified healthcare costs during the tax year. This is very, very important. However, these expenses are deductible only to the extent they exceed a percentage specified of the adjusted gross income. So there is a limit attached to it. So if expenses exceeds a particular limit, then this deduction can be claimed from the AGI. So medical expenses are deductible only to the extent they exceed 7.5% of AGI. So if the medical expenses of an individual exceeds 7.5% of the AGI, then he can claim that amount as a itemized deduction. But again, he has to then compare the amount of deduction that is going to claim for the medical expenses with the standard deduction. If standard deduction is more beneficial, then he will forego the deduction with respect to the itemized. So deductible medical expenses is total medical expenses minus 7.5% of the AGI. So total minus medical expenses minus 7.5% of the AGI is the amount that is eligible for the itemized deduction. This means that only portion of the expenses above the threshold can be claimed as a deduction. What are the qualified medical expenses? Eligible medical expenses that are incurred are the diagnosis, treatment, and prevention of the disease, medical care for the physical or the mental condition, prescription medicines, doctor visits and the hospital services, dental and the vision care, medical equipments, etc. So all these are the expenses which are incurred. And these expenses must be primary for the medical care. Expenses that do not qualify are the cosmetic procedures, general health items like vitamins, supplements, and non-prescribed medications, and the personal care expenses, which are not uh, assumed or treated as the part of the medical expenses, which can be claimed as a part of the itemized deduction. So, what are the key conditions that needs to be fulfilled before claiming the medical expenses as itemized deduction? To claim the medical expenses deduction, the taxpayer must itemize the deductions, cannot claim the standard deductions. This is very important. He has to either claim either standard deduction or the itemized deduction. Expenses must be paid during the tax year. Expenses which has been incurred must be paid during the year in which they want to claim the deduction. So, which means that this has to be incurred by the person, and they must expense these expenses actually before they claim as a deduction. Expenses must not be reimbursed by the insurance or anything, which means that the expenses has to be actually a cash outflow from the individual, and there is no reimbursement or amount which is going to get from any other for meeting those expenses. There should be no reimbursement or any from any source or from any insurance company. So importance of the medical expenses deduction is deductions help the taxpayer to reduce the taxable income for the higher medical cost, manage the financial burden for the healthcare expenses, and then benefit from the tax relief during the period of the significant medical spend. This is very, very important. And the limit which is available for reduction is on the AGI. First, they have to apply the limit of 7.5%. The expenses which are incurred minus the 7.5% of the AGI is the amount that can be claimed as the medical expenses deduction. So we'll move to the next slide. Second important deduction that we're going to talk about, which can be claimed as a part of the itemized deduction, is the state and the local taxes deduction, which we normally call as the SALT or SALT. So how this works then? The state and the local taxes deductions allows taxpayer to deduct the certain taxes paid to the state and the local government as the part of their itemized deductions. This deduction helps to reduce the taxable income by allowing the taxpayer to deduct the taxes already paid at the state level or the local level. So, which is that because we know that the way the US taxation work is that US is a federal, and then we have the state, and then we have a local taxes. So each state has a jurisdiction, and even the local taxes has their own jurisdiction. And a particular assessee, if he is resides in a particular state where all the taxes are applicable, then he has to pay multiple taxes for the state level as well as the local taxes. So in which case that he can then claim the deduction for the taxes which he has paid on the local and the state level taxes. The salt deduction is claimed on the Schedule A, which is a schedule in which itemized deductions are reclaimed and then transferred to Form 1040. Type of the taxes included in salt deduction are state and the local taxes. Taxes paid on the income to the state or the local tax government include withholding from the salary or the estimated tax payment. So, which are the taxes? Taxes paid on the income or the state tax local government includes withholding taxes, and then the state and the local taxes, which are the taxes may choose to deduct the sale tax instead of the income tax. Useful for individual living in the states with no income tax. So Taxpayer may choose to deduct sales tax instead of income taxes. So again, deduction is either of the two. They can choose the sale tax instead of the income taxes. Important is that you can deduct either the income tax or the sale tax, but not the both. So which means that because a particular income tax is also being charged by the state as well as the local authorities, so you can either claim the income tax or the state tax, whichever is beneficial to the SSC, but this SSC cannot claim the both. Then uh, then we have the property taxes paid on the real estates, and they must be paid by the assessor on the value of the property. So salt deduction limit cap is that total salt deduction is subject to the overall limit. So all taxpayer with 10,000 per year, and then married filing separately is 5,000 per year. So this is the amount of deduction that can be claimed as the maximum amount of the taxes which can be claimed by the individual. So important rule is that only taxes actually paid during the year can be deducted, like the medical expenses which actually incurred should be actually taken as a part of the itemized deduction. Likewise, the taxes which are paid during the particular tax year, those are actually eligible for the claiming the deduction. Taxes must be imposed by the state or the local authorities. Federal taxes are not deductible. Must itemize deductions to claim the SALT. So important salt deductions reduce the taxable income, provide the relief to the double taxation, and it especially benefits the taxpayer in the high tax rates. So however, 10,000 cap limit is the total benefit, particularly for the higher income taxpayer. So which means that this is the limit that is available. But again, one has to compare, because if this limit is less than the standard deduction, then obviously one should go for the standard deduction. But if the combination of the medical expenses and state and local taxes exceeds the limit of the standard deduction, then it should one should go for the itemized deduction by claiming the medical expenses as well as the salt deduction together, along with the other itemized deductions that are available. So with this, we'll move to the next category. Okay. Now we'll look at the third itemized deduction, which is the mortgage interest deduction. What mortgage interest deduction means? Mortgage interest deduction allows taxpayer to deduct the interest paid on the loan used to build any house or substantially improve a qualified residence. It is one of the most significant itemized deduction that helps the homeowners to reduce their taxable income. So deduction is claimed under Schedule A and then reported via Form 1040. So what qualifies for deduction? Interest is deductible if it is paid on the qualified home loan, and qualified residence include the primary residence or the secondary residence such as the vacation home. And what is the limit? Loan limit for deduction: the amount of the mortgage debt eligible for interest deduction subject to limits. Loan taken after tax law changes up to 7,50,000. Married filing separately is up to 3,75,000. This is the eligible debt on which interest will be calculated, and that interest element will be subject to deduction. What does not qualify? Loans not secured by the qualified residence, interest on the personal loan, mortgage interest beyond the allowable debt limit, and home equity loan interest unless used for the home improvement. And then how it has to be reported? Lender report the mortgage interest paid during the year in the form 1098, and this form 1098 is available with the IRS, who can then compare the data with the Schedule A, which is being filed by the taxpayer to claim the deduction for the interest on the mortgage loan. The taxpayer uses this information to claim the deduction on the Schedule A. Benefit is that it reduces the taxable income, encourages the home ownership, and provide the tax relief to the house related costs. And want to use the deduction? Taxpayers should claim the mortgage interest deduction when they have itemized deduction, and then the total itemized deduction exceeds the standard deduction, and then they have a significant home loan interest expenses. So if these conditions are there, then definitely it's a merit for an individual to claim the itemized deduction and then claim the mortgage interest as a part of their itemized deduction, rather than being using the standard deduction, which is lower, lesser benefit when compared to the itemized deduction. So with this, we also cover the third head, and then we'll move to the next head, which is the charitable donation. So next head that we're going to talk about is the charitable contribution deduction. So charitable contribution deduction allows the taxpayer to deduct the donation made to the qualified charitable organization as a part of their itemized deduction. So this deduction encourages individuals to support non-profit and charitable activities while reducing the taxable income. Charitable contribution is reported on Schedule A and then included in Form 1040. So what qualifies as a charitable contribution? So charitable contribution is a voluntary donation made without receiving a substantial benefit in return. And these donations include the cash donation, which is money, checks, electronic transfer, property donation, clothing, furniture, vehicles, securities such as the stocks of the mutual fund, and contribution to the religious, educational, and the non-profit organization. And what are the qualified organization? To claim the deduction, contribution must be made to qualified organizations such as registered non-profit organization, religious institution, educational institution, and the government entities. Donations to individual or non-qualified organizations are not eligible for the deduction and hence cannot be claimed as an itemized deduction. Charitable contribution is subject to the limit based on the adjusted gross income. Cash contribution is up to the 60% of the AGI. Property contribution is lower limit may apply. So, and any excess contribution may be carried forward to the future years subject to the limits. So, these are the itemized deduction that we talked about, and then we have one more which is like deduction which can be claimed as a some benefits on the disaster, natural disaster, which is again dependent on the case to case basis. So largely with this charitable contribution, we cover all the four major head of the itemized deduction, which an SSC or individual can claim in lieu of the standard deduction. And then by combining all these four deduction, individual compare the benefit that accrues to them in form of the standard deduction, and then take a judicious call whether he or she has to claim the itemized deduction or go for the standard deduction. So we'll move to the next slide. So for charitable contribution, there are certain set of documents that are required before an individual can claim the amount as a itemized deduction. For cash donation, bank record or receipt is required. Donation which is less greater than $250, written acknowledgement from the charity is required. Non-cash donation, detailed description of the fair value is required. Uh, Benefit of giving the donation to the charitable institution is to reduce the taxable income, support the charitable causes, and encourage the philanthropy and the social welfare activities. So we'll move to the next slide and see that how an individual has to do the comparison to get the maximum benefit while claiming either the standard deduction or the itemized deduction. Okay, now we'll talk about how we have to claim the choice of deduction, what is the method and what is the approach that needs to be adopted. So after calculating the adjusted gross income, taxpayer must decide whether to reduce their income using the standard deduction or itemized deduction. This decision directly impacts the taxable income and the overall tax liability. Taxpayer can choose only one option each year, very, very important, whichever provides the greater tax benefit. The standard deduction is claimed directly in Form 1040, while itemized deduction are detailed on the Schedule A, and then information from Schedule A will flow into Form 1040. So key decision rule is that choose the option that result in the higher deduction. So itemized deduction is greater than standard deduction, then choose the itemized deduction. If standard deduction is more than the itemized deduction, then choose the standard deduction. Factors needs to be considered is that several factors influence this decision like total deductible expenses. If the taxpayer has significantly expenses such as the mortgage interest, salt, charitable contribution, medical expenses, then itemized may provide the greater tax saving. And the standard deduction amounts vary based upon the filing status, which is single, married, filing jointly, or head of the household. This affects the comparison with the itemized deductions. So we'll move to the next slide. So in terms of choice of deduction, when we look at the simplicity versus complexity, so simple and quick is standard deduction, no documentation is required and less time consuming activity, next time consuming when the standard deduction is there. But itemized deduction require detailed record keeping, documentation is required and it is more complex. Certain taxpayer may require to itemize or may not qualify the standard deductions, such as married individual filing separately when one files. So basically, this is a exception to the standard deduction. If they are married filing separately and one of the spouse is already claiming the itemized deduction, then other spouse cannot claim the standard deduction. He can though claim the itemized deduction as well. Certain non-resident taxpayer cannot claim the standard deduction and dependent with the limited standard deduction. So these are like limitation to the standard deduction, whereby dependent can claim the standard deduction which has a limit attached to it, and that deduction cannot increase the limit. So we already had this discussion when we were discussing the standard deduction. So impact on this taxable income, standard deduction method of if the standard deduction is there, then deduction is lower deduction, which means that higher taxable income. But if individual is claiming the itemized deduction, then it is higher deduction and then the lower taxable income. So importance of the decisions choice is critical because it directly affects the taxable income, influence the final tax liability, can result in significant tax saving and impact the overall tax planning strategy. So we'll move to the next slide then. Okay, now we'll talk about a detailed example whereby we are going to consider and understand that how individual can claim both the standard deduction, can claim either of the standard deduction or itemized deduction. So we have a scenario: Sarah is a taxpayer who already has calculated adjusted gross income and now decides whether to claim the standard deduction or the itemized deduction. So step one, that determine the adjusted gross income. So we have adjusted gross income of $80,000. Step two is identify standard deduction. Standard deduction as per the single filing status is limited to 13,850. Step three is to calculate the itemized deduction. So she has the final following itemized deduction: medical expenses, salt taxes, mortgage interest, charitable contribution. Total itemized deduction is 22,000. Step four is compare both the standard deduction as well as the itemized deduction. So in this case, itemized deduction is more than the standard deduction. Then definitely the beneficial for Sarah is to claim the itemized deduction, and this will reduce from their adjusted gross income to get the final taxable income. So reporting this deduction, if the standard deduction is chosen, report directly into form 1040. If itemized deduction is chosen, then report it through Schedule A, which then transfer into form 1040. This is a quick demonstration that how an individual can compare both the deduction and then take the call. This is the best of the two options. So with this, we'll move to the final takeaway slide for this chapter. Okay, so now what are the key takeaways from this chapter? So we understood that deductions are applied after AGI. Standard deductions and itemized deduction are two set of deduction which is being available to an individual, and then they help them to reduce their taxable income. Only one of deduction is can be availed by necessity. Either he can claim the standard deduction or then can claim the itemized deduction by filing in the form Schedule A. Standard deduction is simple and fixed because this is based upon the filing stated, and the limit is being set by the IRS on each tax year, and then it can be claimed directly in the form 1040. Itemized deduction are the relief for the medical expenses, the SALT, which is state and local taxes, mortgage interest, and charitable contribution, and then these needs to be reported in Schedule A, which finally flows into the form 1040. The option of claiming the deduction depend upon the person who is claiming the benefit for either for the tax standard deduction or for the itemized deduction. Documentation is required whenever there is a claim for the itemized deduction, and all these documents needs to be maintained. And then it is very much important by the SSC to weigh each of the deductions separately and then compare with the both the deduction and then take a decision which deduction needs to be applied for. And then basis they can help them to reduce the taxable income. So with this, we come to the end of this chapter. Let's move to the final closing slide and see what we're going to cover as a part of the next upcoming chapter. Okay, so in this chapter, we explored one of the most important decision in the tax calculation process, that is the choosing between the standard deduction and the itemized deduction. So we begin by understanding the concept of the AGI, then how these expenses will help us to reduce the final taxable income. Most importantly, we saw that taxpayer must choose the option to provide the maximum deduction, thereby reducing their taxable income and the overall tax liability. So this part of the tax computation, we have moved from the gross income to adjusted gross income to the taxable income. Now comes the final and most important stage of the tax calculation. So even after arriving the taxable income and computing the tax liability, the US tax system provides additional benefit in the form of the tax credits. So unlike deduction, which reduces the taxable income, tax credits directly reduces the amount of the tax. So which means that once you have derived the AGI, you have claimed the standard deduction or itemized deduction, you calculate the tax on your taxable income. And once you have calculated the tax on taxable income, then you can apply some of the tax credits, making them extremely powerful tool to tax saving. So in the next chapter, we'll explore what tax credits are, the difference between the refundable and the non-refundable tax credits, common tax credits available to the individual, and how tax credit reduces the final tax liability. With this, we'll move to the next chapter, and we are going to come up with the next chapter very soon on the tax credit. Until then, have a nice day and stay in touch and subscribe our channel and watch our video. Thank you.